So far in 2023, the market has certainly defied expectations. The Dow, S&P, Nasdaq, and bonds are all in positive territory. Goldman Sachs and Vanguard have raised their year-end targets, and Fidelity says we may be on the verge of a bull market from the October lows of last year. As we head into the second half of the year, I see distinct headwinds and tailwinds for this market. When it comes to headwinds, leading contraction indicators are signaling a future slowdown. Commodity prices are falling, earnings forecasts for 2024 are lower, consumer spending is excessive over income, and if this consumer slows down their spending, that will lower economic activity. And commercial real estate is certainly a drag on banks right now. When it comes to tailwinds, the Fed hikes are near the top, and the two remaining hikes are likely priced in. But if they give us a third or even fourth hike, that will add volatility. There's an excess demand for jobs. Anyone who wants a job, there's a job available. So the Fed doesn't have to worry about its other objective and can solely focus on fighting inflation. So far, year to date, earnings were not nearly as bad as what was feared, and AI is clearly an emerging force. When it comes to stocks, we're still on recession watch. We're not out of the woods yet. It is possible that momentum carries stocks higher in the short term. Breadth, or the number of stocks with positive returns, is widening, which is a very good thing. And right now, value stocks have the best valuations in the market. When it comes to bonds, there's little to no yield advantage to take on credit risk versus treasuries right now. You need to go down to single A or triple B credit qualities to see any distinct yield advantage. And I'm not sure credit bonds will offset equity risk. In my opinion, the correlations between stocks and bonds is broken. When corporations have lower earnings, then the ability to repay their bonds comes into question, which adds to bond volatility. So what should you do right now? Well, it depends on your perspective and the need for your portfolio. If you're a retiree and you're trying to preserve your wealth, I think it's really important to be bipolar here, focusing on growth and defense at the same time. At Sevey Wealth, we use spending buckets versus a systematic withdrawal plan to buy time and ride through any short-term volatility. I think it's also really important to focus on quality, both bonds and stocks right now. Focus on risk and tax efficiency of the portfolio. And any and all risk assets you have in your portfolio, you should have a 10-year time horizon. If you're saving for retirement, I would absolutely be buying the dips, staying disciplined, and staying invested. At CV Wealth, we're dedicated to helping you manage your own wealth. We offer unparalleled independence, transparent flat fee pricing, not a percentage of your wealth to help you with your money, and you have the final say on everything. Please reach out to me, schedule a complimentary review, and see if CV Wealth can help you. Until next quarter, thanks for watching.